Indian equities put Tuesday's 7-month lows in the rearview mirror. Indices end higher after another highly volatile session. The sensex and nifty end over 0.5% higher, led by IT stocks. Mid-cap counters continue to come under pressure.
Steady third quarter for HDFC Bank. Net profit grows 2% on a year-on-year basis. Net interest margins come in at a 4-quarter low. Slippages are up by 12% on a quarterly basis.
Polycab reports a mixed quarter as revenue misses but margin beats. Indimart shares plunge after a weak showing in Q3. SAI and DLM declines as higher employee costs hits the margin and profits in the third quarter. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to prep you up for tomorrow. I'm Reema and with me is Prashant. Prashant, a much better day, right, compared to yesterday?
I don't think we could have taken one more slam dunk kind of a day, right? And
but mid-caps did get slammed down.
Mid-caps did. Some recovery towards the end, but 2-3-4%, that's it. I mean, sharp cuts still there. It was just a hunch, and we were talking about how maybe the market finds a base around the levels where it got to yesterday. It briefly broke 23,000 on the Nifty and then, of course, saw a little bit of a recovery. We basically left off around the 13th lows, last Monday's lows. And today, starting 2:10 p.m., the market staged a bit of a recovery and we ended about 23,100 plus. It's too early. Let's see. People have been, every day the market stages some recovery. I mean, people come back with full hope that this is it and this is the turn. So far, it's not panned out that way. But it's also, of course, completely true that the market here has been a big underperformer this year so far. For the Nifty Bank, that level is on the downside is 47,898. That is nothing but the 13th of January low, last Monday's low. While the Nifty broke that low, Nifty Bank is not. Today's low is higher than the earlier one. Declines, and that speaks to the broader market damage. Outnumber advances some 3:1. And here, of course, the damage is largely in high PE stocks. Of course, you can wonder what is low PE or what has been low PE, and you'd be struggling for answers. But the exceptionally high PE names, you look at the EMS companies, Dixon, Keynes, Sirma, PG Electroplast, etc. Even some of the real estate companies which had sort of gone berserk. Those are areas which is seeing a lot of pain. But it's not just limited to those. Many other stocks from various sectors are seeing a fair bit of selling pressure. Reema.
Okay, let's take all these stocks. We'll take these stocks forward in greater detail. Let's tell you what we've lined up for you on our show today. The big movers of the day, we'll get to Vivek in just a bit. Then you've got all the market events, the big corporates that we had a chat with earlier. So let's kickstart the show with Vivek, and he's going to put the spotlight on all the big movers of the day.
Well, thank you so much. A much better day after 2 p.m. is what the market actually saw. The first stock on the list has to be HDFC Bank. In fact, post the results of HDFC Bank, no negative surprises there. That saw a bit of an up move, and that actually also coincided with the kind of recovery that the market saw. The next set of stocks that did quite well in the session today and that were strong throughout the trading session was actually the entire IT pack. So the Nifty IT index, one of the top gainers, also aided by moves like Wipro, TCS, Infosys, all of these stocks today saw very strong up moves. The other set of stocks, or the other stock that did very well, was Jana Small Finance Bank. Almost at one point of time was poised at the upper circuit. Strong outperformance compared to peers, and this stock did very well in the session today. And MCX yesterday saw a very deep cut, but post the management commentary and a couple of brokerage notes saying that it's not as bad as what the market was earlier fearing. There was a strong recovery today, up almost 4% in the session. It's the kind of recovery MCX saw. But quite a lot of laggards. Remember, the broader end of the markets ended the day with cuts. Polycab. Now, despite what was a beat, especially across margins and profitability, and also a guidance upgrade coming in terms of top line, this particular stock ended lower by almost 6.5%. That is Polycab that we're talking about. The entire real estate pack today, all of them continue to see deep cuts. Names like Macrotech, Godrej, Prestige, all of them with cuts between 4 to 6%. One of the weakest sectors in today's trading session. Something that you alluded to earlier, the EMS teams, they continue to see quite a bit of selling pressure. In fact, the selling pressure continued in a Dixon Tech, almost 3% lower, and it, went ahead and expanded to other names like Sirma, Amber, remember even Cyan, DLM, that stock too post the results saw quite a bit of a deep cut. India Mart, another stock, while the numbers, were okay, the internals, especially in terms of paying subscribers and also a very steep target price cut by Nomura is something that ensured that the stock ended lower by almost 7%. And L&T Finance Holding, yesterday, post-result, the stock held out strong, but internals again over here were quite muted. Analysts cut estimates and one of the top laggards as far as the F&O space was concerned.
Thank you very much for that. Let's invite our guests, Mayuresh Joshi, Head of Equity Research at William O'Neill, and Shrikant Chouhan, Executive Vice President at Kotak Securities on the show. Gentlemen, thank you very much for joining in. Shrikant, first question, what did the technicals of the markets tell you today and how are we likely to perform tomorrow?
Good evening, Rima. Good evening, Prashant. See, what I can make out is that the markets have been deeply oversold, and whenever we see such type of put call ratio for the month and VIX at somewhere close to 16 plus or 17 around, that time most of the time we see some reversal in the market. So based on the overall technical formation, I am of the view that the markets are oversold and they are again rebounding back to the earlier resistance, earlier support levels of 23,350 or 400 sort of level. So again, we may see the levels of 23,350, 400 sort of level. But yes, in case if the market manages to surpass the level of 23,500, then in that case, the possibilities of hitting 24,000 would turn bright. And today's low and yesterday's low, if we see the levels of the market, then they are almost similar. And tomorrow, in case if we see the market is dropping or opening below the same, then the chances of hitting 22,600 would turn bright. But when looking at the overall activity in large cap companies like Reliance Industries or HDFC Bank, Bajaj Finance, I am of the view that the markets are again heading higher and we could see the levels of 23,400.
Okay, 23,400 possible. So another, 200 points from where we left off today. Well, let's talk about HDFC Bank, which reacted after reporting third quarter numbers. Abhishek is here with numbers from the banking major. Abhishek, over to you.
Well, Prashant, to begin with, it was a mixed set of numbers that has come in from HDFC Bank, almost in line performance with respect to P&L. The agri portfolio has impacted the asset quality this time around. So take a look at the net interest margin. Due to decline in CASA, the net interest margin has got impacted. On total assets, it's at 3.43% versus 3.46% in the previous quarter, a 4-quarter low. Now, other income this time was soft. That is in line with the loan growth that was again on the softer side. The operating efficiency has remained stable, so cost to income ratio has remained largely flat at 40.6% when compared to 40.6% in the previous quarter. Now, ex of treasury, operating profits are up 12.5% YOY and about 2.1% sequentially. This is better than the loan growth that they have seen. The return on asset has come in at 1.9% versus 1.96% in the previous quarter. Now, there were slippages of 8,800 crore when compared to 7,800 crore. If you take out the agri portfolio from these slippages were stable on a sequential basis. Annualized slippage ratio is at 1.4% versus 1.25% in the previous quarter. Along with agri, the gross NPA ratio has come in at 14-quarter high, net NPA ratio at 14-quarter high. Ex of agri, gross NPA ratio has remained stable. The PCR has declined, which is a key negative to note, at 67.8% versus 70% sequentially. The gross NPA ratio, as I mentioned, ex of agri has largely remained stable. Their PNL is better than our poll, both on NII and PAT. Back to you.
Thank you very much for that. HDFC Bank ending with a gain of 1.5%, and it also crossed the 200-day moving average in the up move. Mayuresh, come in on HDFC Bank, and between HDFC Bank, Kotak and the others, where does your preference lie?
So, evening, Riva. I think as Abhishek mentioned, I think if you probably look at the granularity of the numbers, if you take out the agricultural slippages, GNPAs are looking stable. The slippages are probably looking stable as well. The only concern here is the PCR ratio probably coming down. And therefore, I think the management commentary, both in terms of how they're probably stacking up the entire slippages and the restructuring book, along with growth that is probably expected in the next few quarters, is going to be very, very critical for future performance. As far as banks are concerned, and as we look at rating and rankings, on markets with India, I think Kotak Mahindra Bank probably seems to be the best placed at this juncture. Decent set of numbers. Capital adequacy remains very, very high for Kotak Mahindra Bank as well. Expectations of the cost to income ratios are expected to dwindle lower. Asset quality pressures also expected to come off. And though valuations might remain a tad bit higher, I think the rating and rankings of Kotak Bank probably a tad bit better at this point of time.
Shrikant, the chart of HDFC Bank?
Well, for HDFC Bank, the view is that it is very close to its important support levels like 200-day simple moving average. And since June 2024, if you see the overall technical pattern of the stock, then whenever the stock has fallen to 1600 or 1630, from there, most of the time it rebounded back to the levels of 1750 or 1760. This time also, I am of the view that the way the stock has spent time close to these levels, and now the volumes are there, and if we go through with the results, then based on that, I'm again expecting stock to move towards 17, 20 or 30. So quick pullback is not ruled out.
Quick pullback not ruled out in HDFC Bank. Let's get to the other set of companies. That's the cable companies. Now, earlier we had numbers of KEI, Havells. Actually, KEI came out yesterday. But today, during market hours, even Polycab came out with their numbers. Upasana is here with a quick recap.
Well, let us look at the common trend seen in cables and wires company in the numbers reported till now in its Q3 FY25. Now, revenue growth of all these companies was led by stable, strong demand for cables, and cables has certainly outperformed wires. Now, wires saw weak demand and lower growth due to destocking of copper prices softening. Now, copper and aluminium prices have corrected in November to December, which is leading to this. Now, let us look at the results company-wise. Havells has reported a weak set of numbers, lower revenue growth of 11%, which was mainly dragged by company's key segment, that is cables and wires. Now, margins have also seen a sharp decline of 110 basis points. KEI Industries have also reported an overall mixed quarter. 20% of the revenue growth was led by cables and wires segment, in which the revenue grew 26% on a YoY basis. Now, EBITDA margins were also under pressure for this, overall at 9.7%. And lastly, Polycab India reported their numbers today. It was a slight miss on the revenue front, and Morgan Stanley says that the numbers are disappointing when it comes to domestic cable and wire volume growth of the company, which led to this sharp fall in the stock. Now, EBITDA margins was a beat for this at 13.8% with a sharp increase of 70 basis points on a year-on-year basis, while we were working with a poll of somewhere around 12%. So all in all, these are the common trends that we've been seeing in the cable companies.
Okay, no, absolutely. Upasana, thank you very much for that. Mayuresh and Shrikant, the Vedas, Shrikant, the names like Polycab, KEI, RR Kabil, and there are so many others. Anything looks interesting?
Yeah, see, like in this particular space, if we consider any particular stock, then Polycab should be on the watch list because it is correcting from the highs, but at the same time, it is deeply oversold and it is very close to its lower boundary where most of the time the stock has taken support. If we consider other stocks like KEI or RR Cable, I think there the formation is not clear. I'm seeing if there is any weakness in the market, then we could see furthermore deeper sell-off in these stocks because they are very close to their important support levels. But for Polycab, I'm of the view that since last 1 year, if we see the overall trend, then whenever the stock has fallen to 6,000 or 1,500 levels, we saw smart recovery. So in case if there is any furthermore correction, we should look for adding Polycab to the portfolio.
Thank you very much for that, Shrikant and Mayuresh, for joining in. We will slip into a very short break on that note. On the other side, we'll get to the big corporate voices. We'll talk about HUL as well and the Q3 performance.
Okay, welcome back. We've got the market, of course, which saw a bit of a rebound. Earnings so far have kind of largely, at least on the mid-cap front, mostly disappointed. Large caps maybe a little better. Lever is just about come out with its numbers as well for the third quarter. One-time gain boosted profits. for the FMCG giant. Mangalam is here with highlights. Mangalam.
Well, for HUL this time around, the company did not disappoint largely because the street did not expect too much. So in line of that, the numbers are reflecting what is the underlying condition in the demand, which is not much changed from what we've seen in the second quarter itself. If you look at the margins at 23.2%, the street was working with a number of 23.1%. If you look at the revenue as well, it's a 1% growth as against street expectations of 1.5% odd growth itself. The net profit, you would look at it, 3,000 crores versus street expectations of over 2,500 crores, and that's largely because of a one-time gain of 509 crores on account of the sale of Pureit business, which they've accounted for this time around. A large part of the analyst community was expecting an exceptional to come by. It was just the quantum that they weren't making an estimate on. It's 500 crores. So the bottom line has been boosted by an exceptional. If you look at the volumes this time around, the company has reported flat volume growth. Again, the street was working with no more than 1 to 2% volume growth as well. So we can call it a disappointment, yes, but largely in line with no major expectations from Hindustan Unilever this time around. But the highlight of the numbers are the acquisition of Minimalist. Remember, the rumors and news reports were rife that the company would go ahead and acquire Minimalist. They've gone ahead and done that. They believe that this will go ahead and improve the strategic focus that the company has on the beauty and wellness care business of theirs, which in the third quarter has been slightly flattish, 1.5% growth itself as against a much higher number expected, but that's largely because of the delayed winter. So maybe the beauty and wellness business is something that the street will be looking at in the quarters to come ahead. Going forward, the commentary on management as well, there is sustained rural recovery, whereas urban is still under a wee bit of pressure. So those are a couple of things that we'll be watching out for. The stock is down 22% from its highs already. So not much in terms of a downside, but with these numbers, not much in terms of an upside as well.
Thank you. Well explained. And as we wrap the show, we'll bring you the key market events to watch for tomorrow. Vinny's here.
Yes, so important events to watch for on the global front. First, with the US market, we'll watch out for the consumer confidence data as well as in the Eurozone. Similarly, also, we'll be watching out for the consumer confidence data in the Eurozone. In Japan, let's watch out for the trade data that will be coming in tomorrow. So important to watch out for that. On the domestic market front in India, we're watching out for the Nifty weekly expiry that's there tomorrow. Other than that, in terms of earnings from the Nifty side, we have Ultratech Cement as well as Dr. Reddy's, which will be reporting the numbers tomorrow. And another earnings important ones to watch out for, we have Emphasis, Signed, Syngene International, Ujjivan, Small Finance Bank, Indus Tower, Sona, BLW. All these companies also will be reporting their numbers. So a whole lot of non-Nifty companies that are reporting their numbers tomorrow. In some key corporate events that you should be keeping an eye out on tomorrow, Bank of India, IREDA, as well as Ugro Capital will be considering a mulling fundraising plan. So these are the important ones to watch out for in trade.
All right, Winnie, thank you very much for that. So action-packed once again, lots of numbers, etc. as well. Before we wrap, we'll leave you with this week's growth code. This is, of course, a collaborative initiative by Grow and CNBC TV18. Our mission is to equip you with valuable insights and strategies to navigate the markets and make informed investment decisions. Today, we help traders understand the difference between high-frequency trading and algorithmic trading.
Algorithmic trading and high-frequency trading, or HFT as we know it, they're often confused, but they're different. They use computer algorithms, both of them, to execute trades, but the key difference between the two is in speed and strategy. On the one hand, algorithmic trading uses algorithms to automatically execute trades based on set rules like price, there could be volume, time. It aims to trade efficiently to reduce human error and improve the accuracy of those trades. Now, this can involve various strategies such as order routing, market making, or even arbitrage. It's commonly used by institutional investors, hedge funds, and some individual traders as well. High-frequency trading, on the other hand, is a subset of algorithmic trading, focused on executing trades at incredibly fast speeds, sometimes making millions of trades in fractions of a second. The goal here is to capitalize on any tiny price movements that last just nanoseconds or microseconds. The main difference here is speed. Algorithmic trading can execute trades at various speeds, but HFT is all about speed, processing thousands of trades every day. HFT targets short-term gains by exploiting small price changes, whereas algorithmic trading may involve fewer, slightly longer-term trades. Is it suitable for retail investors? Well, for algorithmic trading, it is accessible by various platforms offering automated trading tools, making it useful for individual traders. However, HFT typically requires massive investments in technology and resources, making it out of reach for most retail traders. In short, HFT is a fast-paced subset of algorithmic trading, which encompasses both short and long-term strategies. In short, all HFT is algorithmic trading, but not all algorithmic trading are HFT.